Good morning and welcome to today's Monday morning mortgage update. My name is Sean Wohland, and today we have some really exciting news for you. So let's jump right into it because as you probably have seen on the television, on the radio, everywhere, rates are coming down. And will they come down fast? Well, it's looking that way. So let's have a look to see what's happening with the market. But before so, I'm going to give you a little teaser on a little program I'm going to talk about at the end of this presentation, and that is the non-contingent offer program. So we have a program that will remove the contingency if you have anyone that's selling one home to buy another one. It's not a bridge loan, but I'll tell you more a little bit later. It's a pretty exciting program, and I want to go over that with you towards the end of the presentation. But right now, what is happening? The Feds are going to cut interest rates. There's about a 99.9% chance they will. The question is, will it be a quarter or will it be 50 basis points? So that's the big question mark. A lot of people are saying that it's going to be 50 because they think that he's a little late to the game to cut the interest rates. I could have told you that, but that's okay. He's going to be doing it. And what impact will that have on actual mortgage rates? Well, if you've noticed, mortgage rates have already come down based on the data that is already out there. So let's go over that. And will this cut further lower mortgage rates? Well, let's talk about it. So first off, 50 basis point swing is most likely going to happen, or 25 basis points, but Stand Chart expects 50 basis points. Some key takeaways. They're now certain 25 to 50 basis points. The reason the jobs market was very, very weak when it came out this last Friday. Keep in mind that the jobs numbers that we had over the last year were a lot higher than actual numbers of jobs that were being reported. So now we're seeing some real information coming through. Remember, a lot of this data is late to the game. It's delayed to actually hit the markets. So the damage is already done. The markets have already been somewhat weak, and now the numbers are coming out. So now the Feds have been stuck. They have been torn between keeping rates high to fight inflation because of potential tariff issues and lowering them to prevent unemployment from rising. So they've been torn. They didn't know what to do. Finally, they said, okay, enough is enough. The numbers are out. We need to cut rates. So that's what's going to happen this coming week. So what has that done to mortgage rates already? Well, check this out, guys. Look at this huge momentous swing. So back in June, we were at 98.5 on the Fannie Mae 30-year universal mortgage-backed securities. We went all the way up. Look at this trend line, boom, straight upward. Now, it's never in a straight line, right? But look where we are today. Over the last week, we jumped significantly. The last 5 days in a row, every day was a jump higher. Before that, every day was a jump higher. We saw a little bit of a pullback when we got over the 100.5, but we have been moving forward. Remember, if it's a good number, a good, strong, positive number on the 30-year UMBS, that means mortgage rates are coming down. And if we look at the 10-year, it's the same story. But check this out, guys. Before we do so, this is the 2-year history of the mortgage-backed securities and what they've done. Now, we are on the right-hand side. You see this little arrow here? That's where we are today. But if you go all the way to the left on the timeline to see where we were at the same point, believe it or not, it was almost exactly the same day 1 year ago where mortgage-backed securities were about the same level. Now, they were better back then. They reached all the way up to the next Fibonacci level back a year ago. Will we get there? Will we go through that? Will that be a layer of resistance where we bounce off of it and we come back down? Time will tell, but as you can see, the mortgage-backed securities levels are at the highest they've been in 2 years. This is the second highest they've been in 2 years. So that's a good sign. That's a good thing. We'll take advantage of it, get those buyers off of the fence because this is a momentous occasion. It's always nice when rates get better, right? So let's keep going to see what the 10-year is doing. And look, it fell off a cliff all the way down here. Now, notice that the 200-day moving average, the 100-day moving average, all of the moving averages are way up here. So there could be a rebound backwards. So I think we'll probably bounce off the 4.0 and hopefully we'll gain a little bit more ground so we have some opportunity to lock in some buyers at some good rates before we bounce back up. But that's where we're at, guys, and it's a good thing. So hopefully these will follow us and not vice versa. Hopefully we won't jump back up, but hopefully these averages will come down to meet us down here. So that's my goal. Now, here's mortgage-backed securities rates, or mortgage rates, I should say. Low sixes across the board on 30-year fixed. Keep in mind, this is based on the perfect borrower. So 30-year fixed, 30% down, 800 credit score, single family detached home, primary residence. It's the perfect borrower. That's where these rates are. That's what's posted every day is the perfect borrower. Now, this doesn't take into account points that are being charged. This is the average locks for that perfect borrower through our system called Optimal Blue. So it's going to be in this range, but don't be surprised if your borrower is lower or higher than this. Most likely it's going to be equal to or higher than these levels because of how these are portrayed in the perfect scenario. But it's a good sign anytime we're in the low sixes, right? Look at that in the 15-year in the fives. Yep, I quoted and locked a rate last week in the fives on a jumbo. Super exciting to do that. But yes, rates in the fives. It's been a while, but here we are, guys. Now, is it time to refinance? You may be thinking, wow, if rates are this low, we have some customers out there that they locked in at a time when rates were in the high sevens. Yes, it is time to refinance. However, it is incredibly important that you do it right. I'm going to go over a few things with you to show you how to refinance properly and just some tips so you don't get stuck. Because a lot of people make really poor decisions on refinancing. They do it out of ignorance. So I'm going to teach you a little bit about that and how to refinance in things to take advantage of and to look for. So tips when refinancing. Do not restart the clock. This is the most common problem with refinancing across the board. Somebody will come to you or come to your buyers and say, hey, did you know you can get a rate at 6.125 today? You're at 7.5. That's a savings of absolutely a ton of money, of $400 a month, whatever it may be. And then they put them into a new 30-year fixed. Well, if they've already been in that loan for 3 years, they've made 3 years worth of interest payments. Putting them in a new 30-year is starting that marathon over. It is not a good idea. It's terrible. All of that money goes wasted. You end up paying another 3 years of interest over again. It's a complete waste of money. But did you know you could do any term you want? That is correct. You could do a 27-year term on a refinance if you've already been in it for 3. It's a brand new loan, 27-year term. You can get any term you want above 10. Make sure it's matching or lower than what your actual term is that you have left on the current amortization schedule. That's going to save you thousands and thousands of dollars. So be careful there. Another terrible practice that loan officers have is they say, don't worry, it doesn't cost you anything out of pocket. There's nothing out of pocket. Well, you may think, wow, that's great. I don't have to pay. It's free. No, that couldn't be further from the truth. I've seen quotes come through that are nothing out of pocket, and there's $20,000 to $30,000 in fees that they're rolling into the loan. So your loan goes from $500,000 balance to $530,000 balance. Are you saving money? Yeah, because you're at a much lower rate. So that higher loan amount at that lower rate will still save you a lot of money. But you're financing, you're losing $30,000 of equity. So be very, very careful. Nothing out of pocket does not mean no fees. Super important to look at that. Make sure you're calculating the break-even timeline. Let's just say it costs $3,000 and you're saving $300 a month. You divide the two, so that would mean $3,000 divided by $300 a month. That's only going to take 10 months to break even and actually start making money based on the initial investment of that $3,000 that you paid to refinance. So keep that in mind. You need to know when your break-even point, because if you're going to sell the house in a year and your break-even point isn't for 2 years, makes no sense to refinance. Now, also consider adjustable rate mortgages, because if you are going to be paying off your home in less than 7 years or less than 10 years, an ARM adjustable rate mortgage may be better for you. So if you guarantee you're going to be paying this thing off sooner, or you're going to be selling it sooner than the 30-year, then absolutely look at an adjustable rate mortgage. If you're keeping this home for the long term, do what I do, stay conservative, do a 30-year fix, save that money. But did you know there is such thing as a completely free refinance? Keep in mind, the way we do this is the lender actually gives you money to pay for the fees. Nothing's being rolled into the loan. There's literally no fees. There are fees on the actual settlement statement, but you'll see a lender credit to pay for them. That is a free refinance. The way that works is this. Let's just say rates are at 6.125. You're at 7.5. Instead of getting a rate of 6.125 and saving all that money, you can get a rate of 6.375, slightly higher, which gives a lender credit to pay for the fees. Now you're still saving a ton of money, but there's nothing out of pocket and there's nothing rolled into the loan. Well, why would you do this? You may say, why not get the quarter veteran rate? Well, what happens if rates continue to drop and they drop another half and you spent $10,000 refinancing? Well, if you refinance again, you wasted that money. Doing it free allows you to be repetitive with your refinance so that if rates do drop again, you're not stuck thinking, well, I already paid a bunch of money for refinance. I'm good where I'm at. You can say, well, it was free, no harm, no foul. Let's move on to the lower rate and keep going. So refinancing is going to be key in this next 6 months for a lot of people. So forward this to your customers that have maybe higher interest rates so they know how to do it right. You can always give me a call at the number at the end. But give me a call, shoot me an email, shoot me a text. I'm here to help. And here's the loan product spotlight. So we talked about that non-contingent offer program. What it is, we have an investor that will write a letter good for the mortgage that will say we have a cash buyer for this home. It takes away the contingency and allows the buyer to purchase that home non-contingent. Now there's some strings attached. It's a unique program. Here's a little bit about it. The cash offer letters that go in will allow you to make that offer as a competitive offer with no contingency. So definitely takes the payment away on their DTI, so we don't have to count that payment on their mortgage against them in qualifying. This is the biggest piece of the puzzle that people have a tough time qualifying for. That's why bridge loans are very popular. But this takes the debt to income ratio, takes that payment out completely from their new property that they're buying. Now you do need a platinum credit approval. This is a fully underwritten and approved pre-approval from us. No conditions, the loan's already approved and ready to go. So you have to have this in order for this to work. And it's exclusively only on conventional loans. So keep that in mind. Now, there is a cost for this, and but it's cheaper than other solutions. Let me follow up with just a brief synopsis of this program. The investor's not buying the property from you. They are taking a position to potentially buy it if your home doesn't sell in the next 180 days, but they are putting a letter out there, an offer, an intent to purchase that home, and we, the lender, do not have to count that loan against them in the debt to income ratio when qualifying for the new one. So in this case, in this program, they still need their money. They still need cash from a different source, not from the equity of the house they're selling, from a different source to purchase the new one. So that bridge loan may be a better choice for some people if they need that equity to buy the new house. But this is if they already have a small down payment. Let's just say all they need is 5% down for the new purchase, and they have that in their checking account. Take advantage of this program, and then once that house does sell, you can do what's called a loan recast to take all that equity from the house they sold and put it towards the new mortgage, recalculate the payment to the lower balance payment, and then you're good to go. So this is a great program. If you have any questions on it, give me a call, and it's going to be exciting to see how this can help you and your buyers as we navigate this market.